Halai, and it's great to have you all with us as we dive into an important, often overlooked aspect of fraud in manufacturing. This is the third part of our fraud focus series, and today's session is titled Manufacturing Misdeeds: The Hidden Cost of Industrial Fraud. We're going to explore how fraud can infiltrate manufacturing processes, from procurement scams to product substitution, and we'll discuss the importance of implementing rigorous audit procedures, utilizing forensic analytics, and fostering a culture of transparency to protect your production lines. As we await for everyone to join, I'd like to request you all to type in your name, the organization you represent, and where you're tuning in from. Thank you for introducing yourselves and welcome to today's webinar. Before we begin, a few housekeeping items. Please submit your questions at any time using the Q&A tab, and we will address them towards the end of the session. For any other questions, please use the regular chat. This webinar is being recorded, and we will upload the recording on our YouTube channel, Video East Africa, where we have over 50 webinar recordings from all our previous webinars. Without further delay, let's get started. So the agenda for today is introduction to fraud in manufacturing, the common fraud schemes in manufacturing, why these schemes are so prevalent in manufacturing, understanding fraud in manufacturing, case studies, red flags, behavioral and operational red flags for fraud, and preventing fraud in manufacturing. Now, to lead today's discussion, I'd like to introduce our speaker, Zahir Sheikh. Zahir is the partner for risk advisory, internal audit, and forensic services of BDO East Africa offices in Kenya, Uganda, Tanzania, Rwanda, and Ethiopia. He is a dynamic leader with a high public profile and has been a market leader in chosen markets and services. He was the regional partner responsible for financial advisory services in KPMG in East Africa. Zahir has over 30 years of experience, 7 years in the UK, and 24 years of professional experience gained at KPMG in Africa. He established the first forensic practice in Kenya in 2000 and grew it to a team of 25 full-time forensic specialists in the East Africa region as the regional partner for the Corporate Recovery Business Unit. Zahir has been involved in managing large and complex investigations, providing expert testimony in court, arbitrating disputes, anti-money laundering, asset tracing, ethics and integrity building programs, fraud surveys, training courses in fraud risk, and corporate governance. Our next speaker is Roger. Roger is the Assistant Manager in Risk Advisory, Internal Audit, and Forensics with BDO in East Africa. He is a forensic audit, fraud investigation, risk, and computer forensics professional with over 5 years demonstrated experience in several industries, including NGOs, FMCG companies, manufacturing, and financial services. He has a strong track record in managing critical and high-level forensic investigations and audits and delivering practical, fit-for-purpose solutions to organizations that enable them to meet their strategic and operational goals. He's also highly skilled in developing internal controls, fraud risk management frameworks, and forensic imaging and analysis of suspect computers. Prior to joining BDO, he was a senior associate at Stealth Africa Consulting. I would now like to hand it over to Zahir Sheikh to introduce BDO East Africa.
Thanks, Chandni, and a very warm welcome to all of our participants today. I'm very excited to be here as usual, and I think you can all look forward to a very intriguing and very exciting episode today. Let me just tell you a little bit about BDO for those of you who may not know BDO already, before we hand over to Roger. So BDO is a global advisory and audit practice. We have a footprint that spans 166 countries and territories with 1,776 offices globally. We have revenue. Last year, our revenue exceeded 14 billion US dollars, and we have over 115,000 professionals working for us. The main services that we provide are audit, advisory, tax, and outsourcing services. Next slide, please. So I'll talk a little bit about the services. So in audit, we act as external auditors. We also do audits of donor-funded projects and special purpose audits, special projects audits. We also do audits on internal controls. We do a lot of training on the audit side, such as IFRS training and other technical standards training. Then moving on to taxation services, we have both a compliance unit and we also have a tax advisory unit. Now, on the compliance side, we will do things like filling in your returns, helping you with the submission of returns, any queries, dealing with the revenue authority, and so on and so forth in terms of your taxes due to the government, whether it's VAT, PAYE, and so on and so forth. And then on the advisory side, we provide a whole host of services, including transfer pricing, also international transfer pricing, advice on employment taxes, expatriate taxation, corporate international tax planning. And then also we do a lot of work on tax opinions, and we also do tax dispute advisory work and tax claims work. So basically, wherever you've got a claim from the revenue authority and you need help to fight that claim, then you can call us in and we can bring our experts, our big guns on board to help you reduce your liability to the revenue authority as far as possible. On the outsourcing side, we provide all of the standard services that you would expect from an outsourcing company. We can do your accounting for you and bookkeeping for you if you don't want to put too much money into an accounting and bookkeeping role. This is especially useful for startup and young businesses. We can also provide management reporting for you. We can compile your annual statutory reports. We also provide financial management services and also fiscal management services. We can do a full payroll service for you, so we can run your payroll for you. We also provide company secretarial services, legal services, as well as admin services, and so on and so forth. And then on the advisory side, which is where I sit, we provide internal audit and risk management services, which basically means that if you want to outsource your internal audit, then you can contact BDO and we can actually do the entire internal audit for yourselves. Typically, the saving there is about 70% on your own direct costs. So this is a huge area to look at if you want to have those cost savings, and you also want to have global expertise come into your team. I can tell you the people who are using us at the moment are very happy with our services. As part of internal audit, we also provide a lot of training to the audit and risk committee and also to other key C-suite players in our clients where we do the internal audits as an outsourced service. And then we have corporate recovery, which is a business turnaround service. This is for ailing businesses. So basically, we have corporate doctors, just like you have doctors for people. We have doctors for businesses. And then we also have corporate finance and transaction advisory services. We have a forensic investigations unit, which is what Roger is a part of, and I'm also part of that. And then we have a technology advisory services where we can do IT audits, systems audits, penetration testing, and so on and so forth. We do a lot of data analytics as well. And then we also have whistleblowing reporting mechanisms as well. So let me just pass you on to Roger. Roger, if you want to take it on from there, please.
Sure. Thank you, Zahir, and good afternoon to you all. Pleasure to be here with you. Thank you for joining our webinar. And I'll just take you through quickly, starting with an introduction to fraud in the manufacturing industry. So fraud, as you all know, particularly in manufacturing, is not just a rare occurrence, but it is alarmingly prevalent. And this is the reason why we chose to do this webinar as part of our fraud focus series, that we can expand on this further and just give you some insights. So starting from the ACFE 2024 report to the nation, which is the Association of Certified Fraud Examiners. According to this report, manufacturing ranked as one, or fraud in manufacturing ranks as one of the most fraud-prone industries. And in fact, the median loss from fraud in manufacturing is about $167,000 per case, which is almost the top, as you can see from the data presented here. It's among the top industries that are affected by occupational fraud, only trailing behind mining and wholesale trade. To put this in some perspective for you, organizations in the manufacturing sector experience very significant financial losses compared to other industries. So for instance, the median loss in the retail industry is about $48,000 per case, which means that fraud in manufacturing is over 5 times more damaging than in retail. And this is very concerning given the complexities involved around production lines, procurement processes, and inventory management that are present in manufacturing that create very many opportunities for fraud to occur. One of the most critical challenges for manufacturers is also the duration before fraud is detected. So on average, manufacturing fraud schemes last about 12 months before they are detected and or uncovered. This means that for almost or about an entire year, fraud can remain undetected, which will obviously drain a lot of resources and potentially threaten the stability of the business. According to the report, there are some common fraud schemes in the manufacturing industry, very many that occur, but the 3 most common ones are corruption, billing schemes, and the theft of non-cash assets. And each of them presents very significant risks for manufacturers due to the high volume of transactions, relationships with multiple vendors, and the very large amounts of physical goods that are handled by manufacturers through the supply chain. So just to expound on it a bit further, corruption is, as I said, the most prevalent form of fraud in manufacturing. As you can see from the data from the ACFE report, it affects about 55% of cases in the sector. Corruption usually involves employees misusing their influence in business transactions, mainly for personal gain, and often at the expense of the company's integrity or profitability. The most common forms of corruption are bribery, kickbacks, and conflicts of interest. To expound on them a bit further, bribery and kickbacks occur when employees or decision makers accept payments or gifts from suppliers, contractors, or vendors in exchange for some form of favorable treatment. For instance, a procurement manager may award a contract to possibly a subpar supplier because they have received an under-the-table payment. And this type of arrangement not only results in the company possibly overpaying for services or materials, but it also compromises the quality and the efficiency of the company. Conflicts of interest, which is also another form of corruption, arise when an employee has an undisclosed personal interest in a company with which the organization does business. So, for example, the employee might steer the business towards a family-owned company, even though that company offers higher prices or lower quality products. This again will damage both the financial health and the reputation of the organization. Corruption schemes are usually very dangerous because they involve very senior level employees, and it makes it that much harder to detect and prevent without proper internal controls. The next most common fraud type in manufacturing is billing schemes, and it impacts about 27% of the cases. These schemes involve employees creating fraudulent invoices, either by fabricating new vendors or inflating the prices of quantities from legitimate vendors. Billing fraud is usually disguised within the vast amount of legitimate payments manufacturers make to suppliers, and this makes it much harder to spot through the normal review or audit procedures. Some examples of billing schemes include fictitious vendors. And in fictitious vendors, it's a scheme where an employee sets up a fake company and then submits invoices for goods or services that were never delivered. Payments are then made to the vendor, but in reality, the employee is diverting the funds to their own account. For instance, someone in accounts payable or the clerk could be responsible for this form of fraud. They could submit invoices for materials that were never purchased and then pocket the money. Another example of a billing scheme is inflated invoices, which is where the fraud involves inflating invoices from actual legitimate suppliers. For instance, a production manager might collude with a vendor to overcharge the company for raw materials and then split the extra money between themselves and the supplier. This again will impact the manufacturing company significantly and inflate production costs or harm their profitability. The third most common fraud scheme in manufacturing is the theft of non-cash assets. And non-cash assets include raw materials, parts, and finished goods, among others. It's also the third most common fraud scheme, which affects about 22% of the cases. And like financial theft, which can be tracked through accounting records, theft of physical goods is harder to trace because of the high volume of inventory and the complexity of most manufacturing processes. For instance, the first example is inventory theft, where an employee might just steal valuable raw materials such as metals or other valuable resources and then sell them on the black market or through their own sources and for personal gain. The warehouse worker, for example, might mislabel the goods to make them appear as lower value items, and this is a common scheme that we've seen, and then report that they were damaged, and then this allows them now to take the items without raising any suspicion. Another form of theft is overproduction and diversion, which is where extra goods are manufactured and then diverted to the black market. And for example, a manager might authorize the production of more units than ordered and then siphon off the excess to sell privately. Theft of non-cash assets is also very dangerous to manufacturing because stolen goods are often very integral to production processes, which means that any loss or shortage can cause disruptions, delays, or additional costs for the company. Now let's look at why these particular schemes that we've looked at, corruption, billing schemes, and theft of non-cash assets, are so prevalent in the manufacturing industry. There are 5 main reasons, starting with the complex supply chains. So manufacturing usually involves very intricate and global supply chains, which includes multiple vendors, suppliers, and contractors that are spread usually across different regions. This complexity will create opportunities for fraudsters to exploit gaps in oversight and gain, personally. For instance, the company might struggle to closely monitor the performance and billing practices of all its suppliers, and then provide opportunities for over-invoicing, bribery, and other corrupt practices just to go unnoticed. The next most common, the next reason why the schemes are very common is the high volume of transactions. Manufacturing operations usually involve a very large number of transactions, starting from raw material purchases to machinery maintenance and even to shipping logistics. This is a large volume of transactions, and it makes it very easy for fraudulent transactions to go unnoticed. For example, the inflated invoices that we talked about, or even the fictitious vendors, they can all be buried just in the legitimate payments and make it much harder to detect or delay their detection. The third most common reason is the dependence on physical goods. So unlike usual service-based industries, manufacturers deal with large quantities of physical goods, including raw materials, parts, and also now to the finished products. These are tangible assets, and they are very vulnerable to theft and misappropriation by employees or external parties who can steal items or misreport inventory. And without proper tracking mechanisms, these losses can go unnoticed for extended periods of time. The next is weak internal controls. This is also a reason why manufacturing firms, particularly smaller or mid-sized one, may face these kinds of fraud because they may lack strong internal controls, including segregation of duties. You'll find, like in smaller manufacturing companies, employees responsible for procurement, inventory management, or payroll may have too much autonomy, and this allows them to manipulate processes and conceal their fraud much more easily. Additionally, usually in fast-paced environments focused on production goals, financial oversight may also not be as stringent, which creates now more opportunities for fraud. The last key reason is the pressure to meet production and financial targets. So manufacturing companies usually operate under intense pressure to meet some specific production deadlines and financial goals. And this pressure can drive individuals within the organization to commit fraud, usually to meet unrealistic targets or sometimes to cover up operational inefficiencies like stock losses and so on and so forth. An example that we've seen is whereby a manager overstates inventory levels or production figures to make it seem like the targets are being met, to the CEO, to the board, or to the executive committee, or they can engage in corrupt practices like bribery, just to secure cheaper raw materials, even at the expense of quality. All these factors now combined contribute significantly to the prevalence of fraud schemes in manufacturing. Now let's go just a bit deeper and look at how fraud infiltrates in manufacturing processes. Usually when we think about fraud in manufacturing, it's easy to assume that it's confined just to financial misreporting or theft. But in reality, fraud can infiltrate almost every part of the manufacturing process, from the moment the raw materials are ordered to the time a finished product leaves the warehouse. And where there are three main stages where manufacturing companies are vulnerable to these forms of fraud that we've just discussed. The first one is procurement. This is the very first step where fraud can infiltrate. It's where companies source raw materials and services needed to keep production running. But with so many vendors and suppliers involved, procurement is one of the most riskiest areas for fraud. Employees who handle purchasing decisions usually have a lot of power, and without proper checks in place, it's easy for fraud to occur. For example, imagine a procurement manager in charge of buying steel for a factory, for instance. They might choose a supplier not because they offer the best price or quality, but because the supplier has probably agreed to give them a kickback under the table. And this is a classic case of vendor collusion, where both the supplier and the employee profit at the company's expense, like we've just mentioned earlier. The company now ends up paying much more than it should, and the quality of materials might not even be up to par. And over time, this kind of fraud can now cause or erode profit margins. Another problem that is key in procurement is fictitious vendors, where a corrupt employee now maybe sets up a fake company and submits invoices for goods that were never delivered. The manufacturer then pays the bill, but then nothing was ever received. And with so many transactions flowing through the procurement, the fraudulent invoices can get lost in the mix, especially in large organizations, and make it very hard to detect. The next key step in manufacturing where fraud is highly likely to occur is production and inventory. And this is where a lot of the things disappear. So once materials are purchased, the production flow is where now the raw material will get transformed into finished products. And it's also where a lot of fraud can happen. This stage is also very vulnerable to fraud because there's so much happening at once. You'll find materials are being used, products are being made, inventory is constantly moving, and most factories that we've seen never stop. They operate, 24 hours. And one common scheme in this stage is phantom production, where employees will falsify production records. For example, we've seen cases where a supervisor might report that 1,000 units were produced, when in reality, only 800 were there. The reason they would do this is maybe they're trying to meet a quota for production or cover up inefficiencies. Or worse, you'd find they've conspired with someone outside the company to divert the remaining units for personal gain. The problem is those extra units on paper could end up causing all kinds of downstream issues like inaccurate inventory count, problems fulfilling orders, and so on. Another key example is inventory theft. So imagine you're running, for example, a furniture factory that deals with expensive hardwood. You'd find that workers steal raw materials by reporting them as damaged or lost in transit. And this is very hard to detect if your inventory control systems aren't very good. When goods or materials aren't properly tracked from the moment they arrive to when they're used, it's very easy for fraudsters to manipulate the system and make things disappear. The third key step in manufacturing that's also vulnerable is distribution, because even after the product is made, the fraud risks usually don't go away. In fact, the distribution stage presents its own set of challenges. For instance, once goods leave the factory, they're usually handled by third-party logistic companies, which we all know. And this makes it harder for manufacturers to control what happens next. And this is where now supply chain fraud comes into play. For example, you might find a distributor claiming that goods were lost or damaged during transport, when in fact they were reverted and sold elsewhere. And this type of fraud is known as cargo theft, and it's a growing problem for manufacturers, particularly in our region. Sometimes the employees responsible for shipping the goods might even be on it, and they're working with external fraudsters to siphon off the product. Even worse, fraud can occur when distributors overcharge their services or inflate shipping costs, with some of that extra money going back to the employees inside the manufacturing company who have now colluded or signed off on this deal. And this kind of collusion between internal staff and external partners is usually very common, and it can be very difficult to detect, especially if the fraudsters cover up their tracks by manipulating shipping invoices and delivery records. Now, I think we've seen that fraud in manufacturing isn't limited to one area. It spreads usually across the entire process, from procurement to production to distribution. It can infiltrate every single step and cost you or other manufacturers very many losses, especially if it's left unchecked. The more complex the processes the manufacturing company has, the easier it becomes for fraudsters to exploit these gaps. Now, I'll give you about 3 case studies of fraud that have occurred in the 3 areas that we've looked at previously, starting with procurement fraud. And this is one case that we saw where that involves fictitious vendors in a manufacturing company. So in this case, there was a procurement manager at a large manufacturing firm, and this person was able to set up fictitious vendors to funnel money from the company. This manager was responsible for approving invoices from suppliers, and over time, they created multiple fake suppliers who submitted invoices for goods and services that were never delivered. The fraudulent invoices now appeared legitimate because the manager was the same person who was in charge of approving payments, and obviously he'd approved them, very fast. The scheme that this particular scheme lasted over 2 years, with the payments amounting to millions of dollars deposited into bank accounts. And the key gap in this scenario was the lack of segregation of duties, because as you see, there was one individual who is the manager who had too much control over both the vendor selection and the invoice approval. Also, there were weak internal audit processes because invoices were rarely cross-checked with actual deliveries. And this case highlights the importance of independent reviews and regular vendor audits, because organizations need to ensure that no single employee has unchecked control over financial approvals and invoices as well. The other case study that we look at is in production and inventory. And this is where there was a case of phantom production in the automotive industry. So in this particular case, it involved a supervisor who manipulated production data to report high output that was actually being produced in this automotive company. The factory had aggressive production targets, and then to meet them, the supervisor now falsified records, making it appear that the factory was exceeding its production goals. This discrepancy, because sort of usually a big deal in these companies, it went unnoticed for I think over a year, because the company lacked effective tracking of raw material usage and inventory levels. The raw materials were being consumed without corresponding finished products, but due to very relaxed monitoring systems, the fraud was not detected until there was a large-scale internal audit that was done and sanctioned by the board. By then, the company had lost significant revenue due to the production shortfalls and additional costs incurred from purchasing more raw materials. In this case, the main gaps exploited were poor inventory controls and a lack of real-time production monitoring. So what it teaches us is manufacturing companies should invest in more robust production tracking systems, like the automated sensors, for instance, inventory management software, and so on, that can flag discrepancies almost immediately. The next case that we look at is a distribution fraud case that actually occurred in an electronics manufacturing company. So in this one, there was a major electronics manufacturer who experienced significant losses due to cargo theft during the distribution phase. The company had outsourced its logistics to a third-party distributor, but then employees at the distribution center would conspire to siphon off high-value electronics, and these were smartphones and tablets in particular. The stolen goods were then reported either as damaged in transit, or they were never recorded as part of the shipped inventory, and this now allowed the theft to go on for months. The fraud was only uncovered after one particular customer complained, or a few customers complained about missing deliveries. And then upon investigation, it was found that the distributor's employees had been stealing the product and then selling them in their own means. The key gap that was exploited here was a lack of transparency and accountability in the supply chain, and then it was compounded by poor tracking of goods during transit of the goods. And this also emphasizes the need for tighter controls, such as the real-time GPS tracking of shipments and thorough auditing of third-party logistics providers. Now that we've seen what are the key schemes in the manufacturing industry, and we've looked at actual real-world case studies that have occurred, let's now look at some red flags or common warning signs that will help us to identify fraud in manufacturing. As we've seen, fraud in the manufacturing industry can happen at various stages, whether through procurement, production, inventory, or distribution. And it's essential to know what to look for, because early detection can save your company from significant financial losses and operational damage. As we've seen in the previous cases we've looked at, the cases go on for years. The ACFE statistics said that fraud in manufacturing usually goes a year without being detected. And the way to cover this is to identify some common red flags that can help prevent and identify these fraudulent activities. So we look specifically at behavioral red flags and operational red flags. Starting with procurement, some of the procurement fraud usually can take many forms, as we looked at, from kickbacks to invoices to inflated invoices and so on and so forth. So the red flags that you should spot for, one could be sudden or unexplained price increases. So this is one of the most obvious signs of procurement fraud, which is where the price of goods from a specific vendor increases unexpectedly without a reasonable market explanation. This usually or possibly can indicate that the vendor is inflating the prices in collusion with the procurement officer, especially if other suppliers in the industry haven't adjusted their pricing. The next one is the repeated use of a single supplier. So when an employee repeatedly uses the same vendor without going through competitive bidding, it could also indicate favoritism or kickbacks, because the lack of vendor diversity or ignoring less expensive alternatives may point to fraud. The next one is unnecessary or excessive orders. I think you should keep an eye on for orders that don't match the production needs. So for instance, if a production officer is ordering excessive quantities of materials or necessary goods, it might be their way of siphoning off company funds or receiving personal rewards now from the supplier. The other key red flag is irregular or missing documentation. Fraudsters usually try to cover their tracks by submitting incomplete or vague invoices. The missing purchase orders, delivery confirmations, or approvals that are missing are usually red flags that something may be wrong. Every transaction in the industry should have clear, detailed documentation. And when this is not there, it's a big, big red flag of fraud. The other one is discrepancies between ordered and delivered goods. So it's usually very essential to check or cross-check invoices with the actual deliveries, and this should be done regularly, on an ongoing basis. Because if there's a pattern of receiving fewer goods than are ordered, but being billed for the full amount, it could indicate that someone is pocketing the difference. And the last one under procurement is vendor-specific price deviations. So if you notice prices from a vendor consistently deviate from market norms, this will indicate fraudulent behavior. Because when vendors consistently charge above market rates, and especially when these deviations are industry-wide, and you find this in your industry, it's time to investigate for fraud. I'll give you some common warning signs now for production and inventory fraud. The first one is mismatched inventory records. And this is one of the most telling signs of fraud, when inventory on hand doesn't match what's recorded in the books. And a lot of factories have faced this during their stock takes. This can be due to theft or fraudulent reporting of materials used in production. Regularly auditing inventory records and comparing them to physical counts can help catch this early. The next one is high levels of unexplained waste or scrap. So waste is usually part of the manufacturing process. Consistently high levels of waste, however, can be a cover for fraud. Employees might report materials as waste or scrap and then steal them. In an unusual spike, if you notice an unusual spike in waste report, it's a red flag that's worth investigating. The third red flag is inconsistent production output. So if your reported production levels are higher than what your raw materials realistically produce, it's a red flag. This could be, you'd find a case of phantom production, where employees report more output than was actually produced. And this is done now to cover up missing or stolen materials. The next red flag is unusually high return rates. A high number of product returns. If you notice a high number of product returns due to defects or poor quality, could indicate that there are substandard materials that are being used, possibly as a result of substitution fraud. You'd find that employees or suppliers are replacing the high quality materials with cheaper alternatives and then pocketing the difference. The next red flag is frequent inventory adjustments. So if you find inventory counts are being frequently adjusted without clear explanations, this is a sign that someone is manipulating the records to cover up other fraudulent activities. So you should do regular and significant. If you find regular and significant adjustments, these should always raise your suspicion. And the last one is material substitutions. So if you notice that finished products are not meeting quality standards, it could indicate that there are lower grade materials being substituted for higher quality ones. And this form of fraud is usually very difficult to detect unless detailed material and quality control checks are in place in your company. Lastly, I'll give you some common warning signs for distribution fraud. This is where products are shipped out to customers or distributors. The 4 common warning signs that I'll give you, or common red flags. The first one being frequent delivery discrepancies. So if you notice that your shipping records don't match what was actually delivered, there's a risk that there was cargo theft or diversion. So you should watch for patterns, specifically where high valued goods are consistently marked as lost or damaged in transit. The next one is excessive shipping costs. So if you notice a sudden or unexplained increase in shipping costs, particularly by your third-party logistics provider, it could be a sign that there's some fraud occurring. You find that there's collusion between employees and the logistics providers, which could lead to inflated invoices and then the sharing of the extra funds between them. The third one is missing or incomplete shipping manifests. So proper documentation, as you all know, is essential during distribution. So if you find missing manifests or incomplete delivery records, or even discrepancies between what was shipped and what was actually received, all this can indicate that it's fraud. And then you should regularly audit your logistics and shipping documents to catch any of such inconsistencies. Usually the shipping manifests are thrown away or not maintained very well over time. And this also helps the fraud to continue going on for much longer without being detected. The last one is unusual shipping patterns. So if you find that there are repeated instances of products being shipped to unexpected or some unauthorized locations, this could be a sign of fraud. You'd find that maybe possibly your employees are diverting shipments for resale, or the third-party logistics provider employees are doing this for their personal use. So monitoring delivery routes and your destination changes closely should help you in identifying these irregularities. Now that we've seen some common red flags of these types of fraud, let's now look at some behavioral red flags in employees of this form of manufacturing fraud. Usually when employees are involved in fraud, they often exhibit specific behavioral patterns. And while these behaviors may not be immediately alarming when looked at on their own, when combined with the operational anomalies, they become very good or significant warning signs. Some of the behavioral indicators that you should look out for, starting with sudden lifestyle changes. And this is one of the most common signs of fraud, which is when an employee's lifestyle doesn't match their salary or what you know their salary to be. So if you notice that someone is suddenly, for instance, driving an expensive car or buying luxury goods or taking some extravagant vacations without any obvious explanations that you know, such as a promotion or inheritance or a bonus or so on, it could be a red flag for fraud. People who are committing fraud will often use the money they've obtained to live beyond their means. And while they think they're being discreet, these sudden changes in lifestyle are usually quite noticeable. Another key red flag, behavioral red flag, is refusing time off. So usually fraudsters will fear that if they step away from their responsibilities, someone else might uncover their wrongdoing. You know, they've been covering up the fraud, they've been submitting fraudulent invoices or approving irregularly and so on. And they're afraid that if they step away, someone now who will come to do their work will uncover this. So if you have an employee in your manufacturing company who almost never takes vacations or sick leaves or insists on handling some certain tasks alone, or is overly protective of their duties, it's a key warning sign for fraud. The reason behind this behavior is simply because if they're not there to manage their scheme, they worry it will fall apart. And then someone will discover their fraud. So it's worth taking a bit deeper if you notice this kind of reluctance in your employees. The third one is unusually close relationships with vendors. So in procurement fraud, personal relationships between employees and suppliers can signal collusion. If an employee you find is regularly socializing with a vendor, giving them preferential treatment, or seems to have a relationship that goes beyond professional boundaries, it might indicate that they're benefiting personally from this connection. Favoritism in vendor selection, especially when it's not backed by clear business reasons, should be investigated further. The next one is over control of responsibilities or processes. So if you find employees, you'll find that employees who commit fraud will often want to control all aspects of the processes that they're manipulating. For instance, an employee might be very reluctant to share information or delegate responsibilities, and they just prefer to handle everything on their own. This need of control is usually driven by the fear, again, that someone might notice the discrepancies or uncover the fraudulent activity. So if you find that someone is refusing to cross-train others, and then they insist on being the only person with access to very key systems, however small or large, or they constantly block others from accessing certain information, this could be a sign of fraud. The next one is we'll now look at beyond their individual behaviors. They're usually systemic and operational warning signs that can indicate weaknesses in your company's internal controls. And these operational red flags are often the result of poor processes or a lack of oversight, which now make it difficult for fraud to occur. The first one is a lack of segregation of duties. One of the most critical vulnerabilities in any organization is the lack of segregation of duties. So if you find that there's a single employee who is responsible for too many steps in a process, such as selecting vendors, approving invoices, and making payments, it creates an environment that is very ripe for fraud. So without checks and balances, this person could easily manipulate the system. So segregation of duties is essential, and is essential for ensuring that no one person has too much control, and thus reducing the risk of fraud. The other operational red flag is over-reliance on a single employee. In some companies, you'll find that, and particularly manufacturing companies, one employee, usually the one who's been there the longest, will hold all the knowledge about one specific process. And this can be very dangerous, because when someone insists on being the only one to manage certain tasks, whether it's financial reporting or procurement or inventory management, it gives them the power to hide the fraudulent activity. No one else, you'll find, is involved to verify or question their actions. This kind of concentration of control in one individual should always be a red flag if uncovered. So manufacturing companies should ensure that duties are shared and reviewed by multiple people to prevent this kind of risk. The third one for operational red flags is frequent adjustments to changes of records. So if we find that there's an employee who's frequently adjusting financial records, inventory counts, or supplier details without clear explanations, usually after a stock count or after being questioned during an audit, during internal audits, and so on, this can indicate that there's fraud. If there are consistent changes, especially ones that don't have solid documentation or justification, it can be a sign that someone is trying to cover their tracks. So regular adjustment in key systems like financial reports or inventory management system should always be scrutinized to ensure that they are legitimate. The last one is unjustified vendor or inventory changes. So this one, you should watch out for frequent or unexplained changes to vendor contracts, material orders, or inventory levels. For example, if you find that there's an employee who regularly switches suppliers without proper documentation, or they shift inventory records without a clear reason, this is something that's worth investigating. And the reason is these kinds of changes could be used to cover up kickbacks or theft or misreporting in other areas of the business. So strong vendor management systems and inventory tracking tools can help reduce this risk by flagging irregularities. So now that we know each of these behavioral and operational red flags of fraud, and if you pay close attention to them within your processes, you can be able to detect potential fraud before it occurs or before it escalates. In manufacturing, particularly where stakes are high and the operations are complex, You need to be vigilant in both these areas, the areas of the employees and the areas of operations, to safeguard your company's assets, your reputation, and so on. Lastly, we'll look at how to prevent fraud in manufacturing. Preventing fraud in manufacturing means that you have to be proactive at every stage of the process. And we've seen that fraud can occur during procurement or production, inventory management, and distribution. And so manufacturers need to implement some very key strategies or proper strategies to protect themselves in each of these areas. So I'll break it down for you, some 10 key steps or key things that you can do to prevent fraud in each of these areas. So starting with preventing procurement fraud. As we've seen, procurement fraud can easily occur, specifically when there's a lack of transparency or oversight in the purchasing process. So some of the ways to minimize the risk include vendor management and due diligence. So first off, it's essential to conduct background checks on your vendors before you sign any contracts. This means that you verify their qualifications, look at their track record, and ensure that they're financially stable. You need to make sure that you're working with a reputable supplier to avoid the exposure to fraudulent practices like kickbacks and inflated pricing and so on. The next one is enforcing a competitive bidding process. So one of the best ways to ensure transparency is by having an open and competitive bidding process for all contracts. And this forces suppliers to submit fair and competitive bids, making it harder for any under-the-table deals to occur. This also helps you to get the best price for materials or services and protect your company's bottom line. The third key step or key method or process that you can do to minimize the risk of procurement fraud is the segregation of duties, as we've talked about before. In procurement, it's very crucial that no single person has control over too many aspects of procurement. So make sure that one employee is responsible for selecting vendors, another one for approving contracts, and then you can even have an entire separate team for making payments. So by splitting up these tasks, you make it much harder and prevent anyone from individually manipulating the system for their own personal gain. Now, when it comes to fraud during production and inventory management, the key is to have a strong grip on what is coming in and going in out of your facilities, whether it's your factory or your production floor or your warehouse and so on. And some of the ways that you can do this is, one, you can have or use a real-time inventory tracking system. So implementing the system will track materials in real time wherever they are and help prevent fraud. So whether it can be through barcodes or RFID tagging or so on and so forth, or any other ways, these are the two most common ways that can help you know exactly where your materials are at all times. And this will now make it harder for anyone to steal or misreport inventory without them getting caught. The next one is regular inventory audits. So even with technology, you still need to audit your inventory regularly. And you need to do particularly physical audits that are applicable in manufacturing, where you manually count stock and help ensure that what's on the shelves matches what's on the system. How you can even improve this further by conducting surprise audits, which now will keep everyone on their toes and make it much harder for anyone to cover up fraudulent activity. The next thing you can do is limit access to inventory. So not everyone in your organization should have access to inventory. There should only be trusted employees who are allowed to handle materials. And even with them, it's important to keep logs of who's doing what. So limiting this access will reduce the chances of theft or manipulation. And if possible, you can even use surveillance in your storage areas to act as a deterrent to fraud. Last one is monitoring material usage closely. So you need to keep an eye on how materials are being used during production, and this will help you to prevent fraud. For example, if you find that the amount of raw material being used doesn't line up with the reported production output, this could be a sign that there is some phantom production or material theft. So you need to make sure that you're consistently reviewing your production metrics and your material usage to catch any discrepancies early. The last key risk is in distribution fraud, and this is particularly when it comes to high-valued goods being shipped out of your warehouse. Some of the ways that you can safeguard it that are simple and clear that many companies may not implement is one, having GPS tracking for shipments, and this is one of the most effective ways to prevent distribution fraud. This allows you to monitor where your goods are at all times and make it much harder for them to be delivered or stolen. With real-time tracking, you can spot any suspicious activities such as rerouting or delays or long stops, and these are things that you can immediately spot with GPS tracking. The next key thing is working with trusted logistics providers. So it's very critical to carefully vet any third-party logistics providers that you work with. And just like with vendors, you need to do your homework before you sign any contracts. You need to make sure that your logistics partners have a strong reputation for integrity and that they offer the ability to track the shipments transparently. That is even provided to you. This ability can also be provided to you. The last one is cross-checking your shipping documents. So you need to ensure that you always check what's recorded on shipping manifests and whether it matches what's actually being shipped and received. If you find that there are products that are consistently going missing or they're being marked as damaged in transit, it's a sign that fraud could be happening. So you need to regularly reconcile these records, and this will help you catch fraudulent activity before it escalates. So now, by implementing each of these strategies that you've just shared, whether through better controls, technology, or stronger oversight, you can significantly reduce the chances of fraud occurring in your manufacturing operations. And as you said, fraud prevention is about being proactive, staying vigilant, and ensuring that you have clear, transparent processes at every step of the way. So I think we've come to the end of our webinar. We're just about an hour in. We can take any questions that you may have at this point.
Thank you, Roger, for an insightful presentation on the hidden layers of fraud in manufacturing. It is critical to understand how even seemingly small fraud schemes can lead to significant losses that impact both financial and operational efficiencies. We have a few questions that have come in, and Roger, maybe you can take over. First question is from Sandeep Kaushik. Did I miss the angles from the sales perspective? What frauds are usually done by the sales team? We also excluded the finance and HR.
Thanks, Sandeep, for your question. I think our webinar today mostly focused on fraud in manufacturing, particularly in the internal systems and employees in manufacturing. We didn't look at the sales, finance, and HR processes. These are covered in different webinars that we've done before. But fraud in sales is, again, very similar to what we've seen before. And I'd recommend that you just go to our video channel. It's called Video East Africa on YouTube. We have an entire webinar dedicated to HR and payroll fraud that will cover both fraud and in HR and finances and sales.
Thank you, Roger. As we wrap up today's session, I want to take a moment to thank you all for attending. Of course, your participation and questions really helped deepen the conversation around industrial fraud. Before we close, I'd like to remind you that today's session is just one part of our fraud focus webinar series. Coming up next, we will be hosting part 4, Logistical Lies, Navigating Fraud in Transportation and Supply Chains on the October 23rd. In this session, we will be navigating the complex networks of logistics and supply chain management to expose fraud and corruption. From fuel theft to cargo diversions, we'll explore cutting-edge tracking technologies and how to ensure that every link in your supply chain is secure. We hope you'll join us for what promises to be another insightful discussion. Thank you all. Hope to see you all in the next session.